a new topic, which is, very realistic, and we are having some serious discussions about this with yesterday, the tax. If I ask you a simple question, do we want to pay tax? Now the question, why we need to pay tax? If it is yes, why we should pay tax? Any reason? In fact, when we say tax, that automatically comes into our mind that the objective of the government is to get some money from the public, right? So these days we are talking that government expenditure is much higher than the government income. If you take our government income for the last 30, 40 years, like 30 years back, somewhere around 1990, the total tax income to the government was like 20% of the GDP or the gross domestic product. If you take your national output is 100, people paid like 20% to the government as the income tax, which is decreased to less than like 7%, 7.7% in 2021. Right? Whereas government expenditure that significantly increased. It was like 13 to 14%, which went up to more than 20%. Now there's a huge gap of income for the previous 30, 40 years. Then what we did, we borrowed money from foreign countries and financed that gap and was living happily. So there was an end for these borrowings because we need to pay them back. So we were paying this for a certain period of time, and now we cannot pay. So that is the problem where we had all these economic, the starting point of all these economic crisis. So therefore, as Rashmi said, of course, if you consider the current situation, we need to pay tax. Right? If we are not paying tax, there's no way to get away from this economic crisis because our income is lesser than the expenditure. Government expenditure is so high, government income, which is basically tax, is very low. So we need to pay tax if we want to take the country to a better situation if we compare it with present economic crisis. Now, in economics, there are several reasons why we need tax. The theoretical interpretation for tax is in different, we can interpret them in a different ways. Like the first thing, health. If government concerned about the health of the general public, government can set some higher tax, like prohibitive. Our target is to, stop the consumption. Like if you take alcohol and cigarette, right? Alcohol and tobacco, we put a very high tax because government is worrying. Government is worrying the health of the general public. So therefore, government set a very high tax, which is called prohibitive tax for alcohol. Of course, there are some other reasons, but we will discuss them later. For the moment, it's a good example. With the health concern, government put a higher tax for alcohol and tobacco, thereby try to reduce the consumption of those items, which is bad for the health of the general public. The second reason, theoretically, why we can say we need to pay tax and why we need the tax is the pollution control, which are called pollution taxes. To protect the environment, government put huge taxes. Like in Sri Lanka, when you are having a vehicle, you emit carbon dioxide and sulfur and all these harmful gases. Therefore, what government does, whenever we renew our vehicle or register our vehicle, they take some tax from us, which is called carbon tax. We need to have some carbon testing, and then we need to pay the tax, which is called carbon tax. Right? So this is because of the environmental pollution, to protect the environment by avoiding environmental pollution. So tax will be there for these kind of reasons, to protect the environment, right, or to provide to protect the health of the general public. The third case is quite important. to provide public goods. There are certain goods that we consume together, and also we cannot exclude the people, those who are not paying the price. Then we call them as public goods. The best example is national security. For national security, nobody pays. I mean, with the price. So this is 100 rupee. This is my 100 rupee and give me 10 days of protection. Likewise, we don't have. So in that scenario, what government does, government get intervene and protect the countries. The government provide the public good like national security. To provide that service, we need money. So government takes tax from the public and put that money on national security. So these are called public goods like national security and environmental protection and so on, like the ozone layer protection. If we protect the ozone layer, everyone get benefited. We cannot say that the people, those who have paid only for the protection of the environment, can get the benefit of the protection of ozone layer. It is not that. Everyone in the society will be getting the benefit. Therefore, government takes tax and provide the public goods. Some of these are not public goods, but in Sri Lanka, we are supplying them as public good, like health, education, and roads and so on, especially the health and education, which are not public goods because we can exclude, we can set a price and exclude those who are not paying. But in Sri Lanka, we expect their returns will be very much higher and for longer. And for example, if you take education, if you do not help the public to get public education, there will be less access for paid education. Many people will not be getting into universities. But we know if someone is getting into the university, his return will be much better to the society. Of course, after getting graduation, he or she will be getting a higher salary. So it's a personal benefit to him. But his efficiency, the way of that guy work is much better than the non-graduate. Therefore, society gets some additional benefit. On the other hand, that additional benefit will not be only for 4 years, because we had 4 years in the university. After that, after 4 years, it will not be ended up. It will be for his life. He will be changing and he will be changing someone else. Likewise, there will be a bigger change in the society. So therefore, government provide education free of charge to all the public in Sri Lanka as a public good. But basically, it is not a public good. We can keep them away. Next one is the infrastructure. As we have seen in the Sri Lankan case, to provide the infrastructure, it is very rare that we get the help of the private sector. Like building a highway from Colombo to Kataragaman. So there are very few cases we are getting private sector for providing this transportation or the road service. Right? One thing, it is a public good. We cannot exclude. Right? On the other hand, the investment is so high. For some infrastructure like building airport, then seaport, and these highways, we need a lot of money, lot of capital. Right? In that case, we need the help of the government. So how government provide those infrastructure services? That is through tax. So government take tax and put that money for the infrastructure building, like roads, ports, airports, and so on. So those are very theoretical explanation why we need the tax. But if you really think why we need the tax, of course, all these like protecting health and environment, providing public goods, or providing infrastructure and so on. If you take all these, at the end of the day, why we need tax? We need to tax for government expenditure. Because there are very few other ways of getting money to the government sector. Maybe state-owned enterprises are there, like this Ceylon Petroleum, Ceylon Electricity Board, Water Board, and so on. These are government-owned enterprises. These enterprises may earn profit. But in other countries, in Sri Lanka, it is not. In Sri Lanka, always we are earning losses for these entities. But anyway, it is a way of getting income to the government. Maybe fines. Some duties and fines are there. It is also an income. And government may sell its own capital assets. Then it will be getting some money. But as a whole, the sustainable way of getting financing the public expenditure is via tax. Therefore, at the end of the day, whatever the reason that we discuss, to provide the government expenditure, to get the government expenditure, we have to make tax. That is what we presently discussing. We are having a huge expenditure gap between public income and expenditure. Therefore, we are going to put tax in different places to get the tax income or income increase. Then with this, we have to pay tax. But maybe let's do and see, should we pay the tax or should not pay the tax after some discussion. To understand about this, what we are going to do, we are going to have one specific tax or a tax type called specific tax or per unit tax. This specific tax means per unit. Whenever we sell something, there will be a per unit tax. Whenever we sell, 1 unit will be get taxed with the specific rate. This is why it is called specific tax. It is very easy to understand the behavior of the specific tax. Therefore, in this class, we will be using specific tax or per unit tax as our discussion, in our discussion. And value-added tax, that is also very common in Sri Lanka. When we are buying goods and services, we are paying value-added tax. So specific tax may be like when we buy a cigarette, or maybe 1 liter of alcohol, they put specific tax. Like yesterday, it said they are going to increase 600. So tax per 1 bottle of 1 liter of alcohol will be taxed with 600 rupees per 1 liter. For cigarettes, maybe 20 rupees per 1 cigarette, likewise. And these are called specific tax. Value-added tax, these are the goods and services tax. Right? So with the increase in the value, the tax rates may change. So like if you are adding value, the difference between your inputs and output is higher than certain, like 10 million, you will be having certain percentage, not per unit, 24% of your total income, or presently 12% of total income. 2 days back, like 8% of total income. So we are charging based on the value added with the percentage. This is called value added tax, which we will not be discussing here, but we will be discussing specific tax. To answer the question, should we pay tax? Because whenever we put a tax, there is something called excess burden of a tax. When we are getting a tax, of course, it's better in some cases to tax the public, but there will be some excess burden with the tax. So here what we are going to do, we are going to study that. For that, we can use our simple demand and supply curve. So these are the simple demand and supply curves we learned previously. So we have demand curve, we have supply curve. Equilibrium price is here, PS or P star, and Q star is here, which is the amount at the equilibrium which is sold in the market without any problem. Now, when we put the tax, what happens? When we put a tax, what happens in the market? The first thing happens, price increase. Why price increase with the tax? When we put the tax, what happens? Government charge the tax from the producers. Government will not have any. These are there are two types of tax because there are two types of taxes which I did not mention here. That is direct and indirect. Direct tax, that is the income tax, which directly affects on us. Like yesterday, they raised the income tax from let's say 4% to 8%. There are different changes, like having several bands. Let's say tax rate was 4, now we are going to increase that to 8. The taxable income was 3 million, now it is decreasing to 1.8 million. Right? So these are direct taxes. Whenever government put the tax, that tax automatically paid by the income earner. In our case, let's say consumer, directly. Right? Income earner will pay the tax. This is called direct tax. But the specific tax and the value-added tax, which we discussed previously, are called indirect tax. They are not, government is not directly charging on the consumer. So what government does, government put that tax on the producer. That is the easy point. If we are taxing at the production point, it is very easy. We can tax it at the source and get the tax to the government. Therefore, these are called indirect tax, not direct. They charge the consumer, but not directly to the consumer. They first charge it to the producer. Producer will shift that to the consumer, depending on the elasticity, which we will be discussing. But here what I wanted to say, we have this supply curve. Why we are having this supply curve? Because it is the marginal cost curve above the AVC. We have not yet learned. So later I will explain. Just remember, this is the cost. To produce 1 unit, it involves like 20 rupees. Right? This is why these suppliers are willing to sell that at 20 rupees. If you take like 1,000 units, production cost is 40. This is why producers are willing to supply that at. Right? So this curve tells us the cost of production to the firms. Then when government put the tax, that cost of production will increase exactly by the same amount. If it is a per unit tax. This is why I got the example of per unit tax, because it is easy. So what happens, like let's say government put 40 rupee tax. Right? So market price was 60, quantity was 2000. At that time, government put a tax, which is 40 rupees per 1 unit. So each and every unit produced by the producer will be charged 40 rupees. So what happens at the end of the day or a month, tax officers will come and evaluate how much they have produced. And then multiply that with the per unit tax and ask, okay, give us your tax collection. So then what happens? For each and every production point, there will be a different price. In this case, it was 60. Now it will be 100. This case, it was 40. Now it is 80. If you take this one 3,000, it is like 80. It will be 120. So all the prices will be increased by the tax. Prices in the sense cost. The cost of production will be increased by the amount of tax, because these producers need to pay this to the government. Then what happens? If you take these different points, so 80, it was 60, now it went up to, it was 40, it went up to 80. It was 60, it went up to 100. It was 80, now it is 120. So by connecting all these new points, we can get the new supply curve as S plus tax. So this tells us the real cost. S was the cost. We add tax to the cost. So we are in the S plus tax curve. Right. Therefore, as one of your colleagues said, when we put a tax, production cost will be increased like this. So this is why supply curve shifted to leftward. So that is what initially happened when we put a tax. When we put a tax, supply curve will be shifting leftward as S plus tax. The current cost plus the tax, because it is a cost to the producer. Then what happens? When we shift the market supply curve from S to S plus tax, we cannot retain, or we cannot retain anymore in the equilibrium point E with 60 rupees. So we are getting into new equilibrium called E1. At E1, price is 80, not 60. Right? So now price increased to 80 and quantity will be decreased from 2,000 to 1,000 because now consumers are facing a higher price. So they don't want to buy like previously. So they will stop the consumption of something. So that will reduce the quantity supplied as well as equilibrium quantity. So E1 will be the new equilibrium price, that is P80. 80 rupees will be the equilibrium price, and quantity will be 1,000 with the tax. Now, if you look at this graph, I told you the value of the tax is 40. This is 40, right? This difference. And if you take any other point like here, if you take a point like here, this is also 40. Here, 40. Everywhere it is 40. But what is the price increment in this case? When we put the tax, there is an increase in price. So what is the increase in price? Is it 40? If it was 60, with the tax, it should be 100. But in this case, it is only 80. Right? We were at 60 and price went up to 80 only by 20 rupees. Right? So initial price was 60, now price has gone up to 20. Then what happened to the tax? The other amount. What has happened to the other 20 rupees? There, when we put a 40 rupee tax, price increased by 20. It was 60, now it is 80, which tells us there's a price increase of 20. Then what happened to the other tax? Whenever we put a tax, sometimes consumer bear the total tax. Sometimes producer bear the total tax. Sometimes both of them bear the tax differently, sometimes equal. In this case, both producer and consumer have borne the similar level of tax because we put 40 rupees as the tax. So the price increased to 80, which means consumers will pay another 20 rupees to buy this good per unit. And on the other hand, producers have already paid like 40 rupees to the government. So additionally, it is getting 20 from the consumer. So then the rest of the tax is borne by the producer. Therefore, when government put a tax on the consumer or the producer shifts some of those tax to the consumer and the rest will be borne by the producer. That depends on the elasticity, which we will be discussing later. But in this point, what I wanted to show you, if you look at the point like here, it was 60, now with the tax it increased to 80. So with the tax, there is a tendency to increase the price. How much we will discuss later, but it will increase the price. And quantity will be decreased. In fact, this is a real problem. Now government is increasing tax of many things, but if the quantity get decreased significantly, of course, government may lose the tax as well as the economy can get into some other problems. So we will discuss that also later about the quantity. But look at this square or rectangle. This area is the tax amount because we are getting 40 rupee per unit. This is 40 and this is the quantity. So this area is the total tax to the government. So when government put a tax, supply curve shifting leftward and we get into new equilibrium, prices, there's a tendency to increase the prices and there's certain income to the government. This is what happens with the tax or with the dynamics in tax. Then the question, why we had only 20 rupees increment in price? Then what happens to the rest of the tax? As we discussed previously, whenever we get a tax, consumer pay certain amount of the tax, whereas producer pay rest of the tax, which is called tax incidence. The technical word we are using is tax incidence. Tax incidence means who pay the tax. And this is what I told you. Price was 60, now price increased to 80. This amount is paid by the consumer. The increment in price is paid by the consumer because consumer needs to pay more money now. If it was 400 rupees before tax, and now the price is 500 rupees. So consumers are paying additionally 100. So that is the amount of the tax borne by the consumers. On the other hand, the remaining of the tax, some amount will be paid by the consumer, then the other, what will happen? So that amount will be borne by the producer. So graphically we can show it. This area is borne by the consumer, right? And this area of the tax is borne by the producer, right? So this is called tax incidence. Who pay the tax? Tax may be paid by the consumer or the producer. In this case, it is very easy. In this case, both consumers and producers are paying equally. There's no difference. Consumers are paying 20 rupees and the remaining 20 rupees paid by the producers. Government is getting 40 rupees. Right? So the payment of the consumers as well as producers are equal. But in reality, real world, it will not happen. Sometimes consumers are paying more, sometimes producers are paying more. Can anyone say what is the reason we are having different amount of tax paid by the consumers and the producers in different goods and services? It is not the same. Any reason for that? Any reason why the consumers and the producers are paying differently? We have already learned the elasticity. Right? Elasticity we learned, that is the response. Response of quantity demanded due to a change in either price or some other variables that affect on the demand. Like price elasticity, where the change in price and the response of change in its own price and the response of the quantity demand. So we learned those. Right? So we learn there are different magnitudes. Sometimes we call elastic, sometimes we call inelastic, sometimes we call perfectly elastic, and sometimes perfectly elastic. Right? So depending on this elasticity, the amount of tax paid by the consumer and the producer determine. So we can say that if you take the case like this, so demand, we are closer to unitary, as we just discussed in the graphical way. The demand curve of this graph is more closer to unitary. But what about the supply? Is it closer to elastic or inelastic? What is the price elasticity of demand of this curve? Not the number, but in generic terms. Elastic or inelastic? The price elasticity of demand, price elasticity of supply of S curve. Is it elastic or inelastic? Can you remember we discussed that, how to define the elastic or non-elastic or inelastic? That is looking at the response. Right? So let's say we are having 60 and price will be increased to 70. What is the change in supply? Change in supply is this much. So that tells us the response is high. If the response is high, we can simply say that is the elastic. Right? Yes, Praveen is correct. The response is high, therefore we say elastic. So supply elastic. When demand is unitary, supply is like elastic. What happens? When we put a tax, since suppliers are elastic, they can adjust quickly. They change their supply. When price increase, they increase the supply. At the same time, if you take the consumer side, what will happen? When the price increase, they will decrease the quantity demand. Right? In this case, the price increment is not transferred to the consumers, to the producers, it is to the government. Therefore, there is no any change in the producer's income. Right? So therefore, what happens? Supply elasticity is high. So the suppliers, they reduce with the tax increment, they reduce the supply, and consumers, they cannot reduce like that. Therefore, what happens in the market? Consumers will be paying a higher price, whereas producers will pay a lower price because they can get away from the market easily. They can adjust. They can limit their production. When the tax imposed by the government, producers, they will decrease the production quickly. Consumers, of course, they are like unitary. They may not be able to reduce like the producers. Therefore, consumers, they will bear much of the price. So if you look at this graph, you can easily see that. So this was the equilibrium. Equilibrium price is 60, quantity is 2000. Now government put a 40 rupee tax. It is 40 rupee. Right? You can see here it was 50, now it is like 90. So difference is 40. Or if you look at any of these points, this is 60 and this is 100. So 40 rupee. Always there's a difference between the cost of the producer and the price. There is a 40 rupees difference per unit. So tax is 40 rupees per 1 unit. Out of that 40 rupee, if you look at here, you can see 60, original price is 60, equilibrium price. Now it is increased to 90 here. So there is 30 rupee increment in price. There is a 30 rupee increment in price. Who bear that 30 rupee? That is by the consumer. So consumer bear 30 rupee from the 40 rupee tax. So remaining 10 will be borne by the producer. So in this case, producers, they bear only 10 rupee, which tells us if price elasticity of supply is elastic, and then producers bear less amount of tax, consumers bear more amount of tax, because easily they can get adjusted, they can get changed. Therefore, much of the tax will be shifted to consumers. But you remember, I told in the beginning of this analysis, when price increase, consumers, they decrease their demand. Therefore, there's a huge decrease in the demand. So final equilibrium will be like 500 units, whereas initially it was 2000. Now we have only 500 units of demand and supply in the market. We can see the same scenario by shifting the elasticity of demand. Now, in this case, now we are having elastic demand. The previous case we had elastic supply, but now we are having elastic demand. If we are having an elastic demand and set the price, because of the tax, price will be increased or the production cost will be increased, then the same discussion we had previously. When price increase, consumers will reduce the consumption. If elastic means response is high, they can respond very highly or hugely. Therefore, what happens when there's a slight increase in the price, quantity demanded significantly decrease. Producers, they don't want to happen that. So what producers do, they don't want to shift much of the tax to the consumer, because if we shift that to the consumer, consumers will move away from the market. Therefore, producers will bear much of the tax, right? And only shift little amount of tax to the consumers. If you look at this graph, you can see that clearly. Here, you can see this is the equilibrium price. Equilibrium price is 60. And we put a 40 rupee tax. Always you see the difference is 40. 40 rupees per unit. So we put a 40 rupees per unit tax in the market. So when we put that, supply curve will be shifting S plus tax, like in the previous case. And we get into new equilibrium at 1. You can see here, price is 70. Initially, price was 60. Now, price increased to 70, which means only 10 rupees is paid by the consumers, because only 10 rupee increment in the price. If it is only 10 rupee increment in the price, then we don't want, the consumers don't want to pay much. In this case, producers will bear the bigger amount of tax. So tax incidence is higher for producers, whereas it is less for the consumers, because this 30 rupee is borne by the producers. That tells us when the price elasticity of demand is elastic, much of the tax is borne by the producers. Then what about the opposite of this? This is an extreme case where demand elasticity is perfectly elastic, inelastic. Demand elasticity is perfectly inelastic, whereas we are having unitary supply curve. So equilibrium is at 60, like in the previous case. Equilibrium quantity is 2000. Now government put a tax. In fact, this is what government did yesterday for alcohol and tobacco. What government did? Government put a tax on alcohol and tobacco. For alcohol, it is 600 rupees per 1 liter. Then what happens? If you look at the prices today, definitely prices will go up with that the same tax amount. If tax is 600 rupee, 1 liter of alcohol will be increased by 600 rupee, definitely. And this is because for tobacco and alcohol, we are having perfectly inelastic kind of demand. Not exactly, but closer to perfectly inelastic. Response is 0. Price can be changed to any, response is 0. We need that. So therefore, you can see here what has happened to the price. Equilibrium price was 60 before the tax, but when government imposes a tax, what happens? Equilibrium price goes to 100. So all the tax or the total tax amount is paid by the consumer. This is because consumers cannot get away from the market. They will have to buy whatever the price, like medicine or even petrol or gas. You see, gas prices were increased like double, more than double. But still, people are in the queues because they need tax. It's a necessity. Since it is a necessity, consumers cannot get away. In fact, alcohol and the tobacco are not necessity, but they have become like necessity. People, the response for price increments is very, very, very less. There may be some changes for 2 weeks or 1 month maximum. After that, that will get into the normal situation. Now, what you can do when you have a free time, change the shape of the demand curve or the supply curve. Put it to elastic, perfectly inelastic, perfectly inelastic, or inelastic or unitary, and see who pay the tax. And then change the supply curve. Supply curve also put into different degrees of elasticity and see who pay the tax. And finally, change the demand and supply both with different degrees. Maybe perfectly elastic supply curve and inelastic demand curve. And inelastic demand curve and perfectly elastic supply curve. Likewise, change the different combinations and check what will happen to the price, what will happen to the quantity. And thereby you can imagine who pay the tax depending on the elasticity. So later, when you do your research, you can calculate the price elasticity of demand and price elasticity of supply, and then you can just say what will happen if you put a tax, and who is going to pay the tax or much of the tax, whether it is the consumer or the producer.